Hello everybody, welcome back to this video where I will be talking about intermediate macroeconomics, which can also be called advanced economics depending on your college. Basically, it is just the higher level of macroeconomics class that all economics majors will have to take. And so this is going to be the first in a series of videos where I explain all of the concepts that you will need to know for macro. And these videos should not be used to replace your textbook or going to class, but they should be useful for when you have to study for an exam and you need to learn all of the content. And then we will also have some example questions that you can use to make sure you understand everything. And so in this video, we're going to be going over the basic concepts of intermediate macro. And that means I'm going to go into a lot more depth in this video than I will in all future videos, because everything else in macro is built off of these concepts. And so you really need to get them down. And so we'll be talking about three things today. The first is national income accounting. The second is measuring GDP. And the third is savings and wealth. And so my goal for this video is to go over the basic concepts of intermediate macroeconomics, which is how we keep track of production, income, and savings. So the first thing that we're going to talk about is national income accounting, which sounds scary, but in reality isn't that hard to understand. National income accounting is basically how we calculate the size of a country's economy. And most of the time we use GDP to represent this. So if you've ever heard GDP, it just means the size of the country's economy. And so there are a few other ways to calculate the size of a country's economy that we will talk about later on in this video, but for right now, GDP is the most important for you to know. And so there are three different ways to calculate the GDP from national income accounting. The first one is the income approach, and basically you find all of the money earned from the production of a good. And so this can be many things like wages, rent, and interest. If somebody's making money off of it, that means it's going to the income approach. So the second one is the production approach, and this is basically the amount of output produced. And so we basically take the value of all goods made during production and add them up. So if you go to the store and you find an apple, worth $50, that is the value of a good. And so those values are all added up to find the GDP using the production approach. And the last one, and by far the most important, and one that you need to know, the others are not that important to memorize, is the expenditure approach. And this is basically the money spent on all goods by consumers. And so if you're wondering why this is the most common, it's because it's the easiest. It's just that simple. In real life, it is much easier to find this information, the amount of money spent on goods, because companies already keep track of that. If you go like a store, if they sell something to you, they keep track of it and they keep track of how much they sold it for. And so the IRS and other government organizations can basically just take this data and add it all up and find it. So they don't have to do much work by themselves. They can just use other people's work. Whereas with these other methods, they would have to go in and calculate this all manually, which would be very hard. And the good thing is that all of these approaches give the exact same answer. So we can just use the expenditure approach. We don't need to use the income and production approach. And it makes sense logically that all of these things are equal, because money doesn't just leave the economy, it just goes into somebody else's hands. So any output produced is purchased by somebody, which results in that person making money. So somebody producing something equals somebody earning money and then somebody spending money. And so the example that we have is this farmer who is growing apples, which he is then selling to turn into apple pie. And so we start with the farmer growing his apples, which he's selling for $10. And a baker buys these apples and uses them to make a pie worth $20. And so the final good, the pie, is worth $20. But to find it using the production approach, we need to find the amount of value that was added through the production of the good. So we have the original apples, which are worth $10. So we can take $10, and then the baker turning it into the pie added another $10 to the value. So production added $20 of value total. So we get this answer of $20. And if that was confusing, it is confusing to do because you're basically having to do a lot of math where you're just finding the amount of value that producing a good added to it. So like if you turn, trees into paper, if you bought wood for $5 and the paper was worth $20, that'd be $15 of value added. So this would be what you'd be adding up in the production approach. And then going to the expenditure approach, a customer would buy the pie for $20, so the total expenditure would be $20. It's just that simple. This is why we use the expenditure approach. It's so much easier. And then the income approach, you can also see how it's more complex. So the farmer earns $10 from selling his apples, and the baker then sells that pie for $20, but he only earns $10 total because he spent $10 on the apples. So if we just add up the $10 the farmer made and the $10 the baker made, we get the total income of $20 again. So you can see that they're all exactly equal. And because they're exactly equal, we should just use what's easiest for us, which is the expenditure approach. And so the last thing I want to go over for national income accounting is the 4 different types of goods. So the first type of good that we're going to talk about is a final good. And a final good is one that you could buy at the store and then consume. So in the farmer example, it was the apple pie because somebody could go out and buy the apple pie and then eat it. And the biggest distinction that you need to know is that it is not used to make anything else. A good that is used to make something else is an intermediate good. So intermediate goods are used in the production of final goods. And in the farmer example, this would be the apple, because the apples are being used up to make the apple pie. And so the third type of good is a capital good. And a capital good is used to produce other goods as well, but the main distinction is that it is not used up. So I didn't include any capital goods in the farmer example because it would have made it a little harder to understand, but capital goods in that would have been the oven where the pie was baked, because it's being used to make another good, but you can use it again and again. So in real life, capital goods are things like computers, vehicles, machines, and tools. And so these count as final goods because they're not being used up. And the last thing we're going to talk about, which comes in more important when we talk about savings and wealth, are consumer goods. And so consumer goods are specifically anything that you or I could buy in the store. So all consumer goods are final goods, but some final goods, we can't buy in a store. And so there are some final goods that aren't consumer goods. And so there are 3 types of consumer goods. The first is durable. This means something that lasts a long time, so a car. They're non-durable, which are things like food that won't last, like the apple pie. That'll be gone very quickly because you're going to eat the whole thing. And then the last is services. And so this is things like healthcare and transportation that you have to pay for. And so to wrap up this section on national income accounting, we just have to know 3 major points. So we need to know the production approach, which is the value added by the production of good. You need to know the income approach, which is all income earned during production. And we need to know the expenditure approach, which is all spending on final goods. And the most important part is that all approaches give the exact same result. And so most of this national income accounting lesson you do not need to know by heart. You just need to know that all the methods equal the same thing and that expenditure is the one that you should always try and use. And we will give the exact formula for how the expenditure approach is used to calculate GDP in the next lesson. So the next thing we're going to talk about is how to use these three approaches to actually calculate the GDP. And so like we said earlier, the income and production approach are difficult to use, so we're not going to actually go into much detail about how they are used to calculate GDP. If you want to learn more about these, I will have these slides up for you to download, or you can pause the video right now and read through all of this. But basically, you just need to know what we talked about earlier, that the income approach is all of the incomes generated in the economy by the private sector and by the government, and that the production approach is the market value of all final goods produced within a country. And so now we're going to talk about the actually useful approach. So the expenditure approach tries to find a way to relate economic output to money that is spent in the economy. And they do that with the income expenditure identity. And this is the most important thing to memorize. I need to stress that a lot. If you have not written down anything else in your notes, you should write down this formula and the name of it, because it is very important. Most of what we'll talk about in the next few videos builds off of this formula. And so basically the GDP equals to consumption plus investment plus government spending plus net exports. And so these are all ways of money moving around the economy and being spent in the economy. So what do each of them mean? Consumption is all spending by people like you and me and households in the economy on consumer goods. Investment is all spending on the development of new goods. So this can be things like research, research to create new products. It can be the construction of new office buildings. It can be many other things like that. The next one is government spending, which, if you live in the country and listen to the news, you will hear about government spending. This is what the budget is. It's basically any money that the government spends. And so most of what they spend money on is the military, Social Security, and infrastructure. And the last aspect is net exports, which is exports minus imports. And exports is money entering the economy because we're selling goods to other countries, and imports is money leaving the economy because we're buying goods from other countries. And so you can just logically think about this and see that all of these variables are ways of money entering the economy and moving around the economy, because all of them, require money to be spent. So the last thing we're going to talk about in this section is the difference between GDP and GNP. So GDP is the one that we're more familiar with, but it's important to know the difference between the two. And so the easiest way to understand it is that GDP is the where and GNP is the who. And so what do I mean by that? Well, the GDP is the value of all goods and services produced inside a country's borders, regardless of who owns them. So every factory, every office building in America is counted towards its GDP, even though many of those offices and factories might be owned by companies from somewhere else. So the example I have here is that a Japanese car factory in Georgia is part of the US GDP, even though a lot of its economic value is going to Japan because the Japanese company is taking its profits. And so that also means that all of America's offices and factories in other countries are counted towards their GDP and not ours. And then GNP is the value of all goods and services produced by a country, no matter where they are located. So this means that everything that Americans own all around the world is part of its GDP. So America has a lot of factories in Mexico, and these would be part of the US GNP, but since they are physically in Mexico, they are part of the Mexican GDP. And so just remember that GDP is the where and GNP is the who. And GDP is much more common to use basically every country around the world has agreed to use GDP to calculate the size of their economy. And for the most part, this isn't really a problem because the difference between GDP and GNP for most countries is very small. For the US, it's only like 0.2% difference. And it's much easier to calculate GDP, and everybody else calculates GDP, so we just go along with it. And so you can kind of understand the difference between GDP and GNP as everything that America owns abroad minus everything that foreign countries own in America. And so if we take GNP and we subtract all of those payments, which are called net factor payments, that is equal to GDP. So the difference between GDP and GNP is basically all of the assets owned abroad minus all of the foreign assets in America. So to wrap up this chapter, the main points that you should memorize is the income expenditure identity, of course, output equals consumption plus investment plus government spending plus net exports. And right now, if you're learning this for the first time, that might seem a little hard to understand. You might be thinking you're not going to remember all of those different variables, but we use this formula so much in the rest of the course that you will memorize it. Like, it's impossible not to. And then the second thing is the difference between GDP and GNP, with GDP being where production happens and GNP being who owns the production. And so the last thing we're going to talk about in this video is savings and wealth. So whichever textbook you're using for your class probably makes savings and wealth more complicated than it needs to be. In reality, it's pretty easy to understand the difference, especially when you use an example from your own life. So I think of it in terms of a bank account. So saving is the amount of money I'm putting in each month. So after I get my wage and after I spend all the money I need on food and housing and things like that, all of the money I have left over is my savings. And then I put it into the bank. And then wealth is all of the money I have in the account. So it is the sum of all of the savings I have ever done. So every time I add in, if I add $100 to my savings, wealth increases by the same amount. So as your savings goes up, your wealth goes up. And so another thing that we need to talk about is a flow variable and a stock variable, because this comes up quite a bit in later chapters. So savings is a flow variable, which is a variable that's measured in a unit of time, which basically means it's happening over and over again, while wealth is a stock variable, which is a variable measured at a single point. And so wealth, all of the wealth in a country adds up to its national wealth. So the sum of all households, companies, and the government's wealth is equal to national wealth. So you can also think of this as all of the country's assets domestically plus all of its assets abroad. And the next thing we're going to talk about is private savings. And I know that this slide looks very complicated. There's a lot going on here, but I promise it is easier to understand when we break it down. And the first one that we're going to look at is private savings is equal to disposable income minus consumption. So this is a more expanded form of that formula we saw in the last slide, that savings is equal to income minus spending. So consumption is just your spending, it's the same thing. And then disposable income is your income after taxes. It's that simple. And so if we expand that idea, we can get the formula we will be using for private income in the future. Just savings private is equal to, and then all of this in parentheses is disposable income, and it is output plus net factor payments plus transfers plus interest minus taxes minus consumption. And so I am going to explain exactly what each of these means, but for problems, on your tests, you should really just think about what would gain a household money rather than memorize this formula, because there are going to be so many formulas you need to memorize. So if you can kind of just reason this one out and think that, yeah, taxes would be a household losing money, so it's going to be subtracted from that, it's easier than actually memorizing it. So the variables in this section in parentheses are output, which in this case just means the same thing as income. So all the money you make from your job is your output, basically, plus net factor payments. Remember we talked about this earlier. It's all income from capital abroad minus foreign capital inside the country, plus transfers. And probably before this class you've never heard of transfers, but if it is the government paying you money, it is a transfer. So anything, the example I have here is Social Security. That's the most common one, but like the stimulus checks during COVID, those were transfers. Many other like VA benefits and such are transfers. So if the government is paying you money, it is a transfer. It is that simple. And then interest, which is interest paid for government debt. So if you don't know, government debt is the same thing as a bond. And you can kind of think of a bond as kind of being like a stock, where if you buy it, you will potentially gain some money off of it. Bonds are kind of, you will get money off of them. And so the government will basically sell you your debt, so you'll pay them money, and then they'll pay you back with interest. So if you have bonds, this means that you're making money off of the interest from the government. So that's what we're adding here. And then subtracting taxes, of course, because you have to pay taxes, and it's money going to the government, so it's a loss for your private savings. And then finally, minus consumption, which is everything you're spending on goods and services that you use every day, like food and clothes and rent. And so the next thing we're going to look at is government savings. Government savings is also just how much money the government makes minus how much it spends. And so we can expand that formula to give us savings of government is equal to taxes minus transfers minus interest minus government spending. And a lot of this is, again, easy to understand when you think about it. The government makes its money through taxes. And when it's transferring, if you and I are getting money from Social Security, that's the government paying you. So that would, of course, lose them money. And then when they're giving out bonds and such, they're paying you interest. So that would also be them losing money. And then finally, of course, government spending loses the government money. That one is easy to understand. And then lastly, and this will not be as important, it's just kind of like a fun fact that you've probably heard. Positive government savings is a budget surplus, and negative savings is a budget deficit. So if you hear on the news about how the US deficit has gone lower every year after every year, that's what they're talking about, and this is how they're calculating it. And so the last thing we're going to talk about is national savings, which is government savings plus private savings. And this makes a lot of sense when you think about it. And so when we're trying to calculate national savings, we're just going to add these two formulas that we talked about just a little bit ago. So the government savings formula here, and then the private savings formula here. And the good thing is that most of the variables in this formula cancel out. And this makes sense. If you think about it, like all of these variables here, transfers, interest, and taxes, they're not money entering or exiting the economy. They're just switching hands from a private person to the government, or the government to a private person. So if we add together these two formulas, they're going to cancel out. So the variables that cancel out are taxes, transfers, and interest. And that makes sense. And so to simplify this formula, we just have savings is equal to output plus net factor payments minus consumption minus government spending. And so this formula is somewhat important for you guys to understand. It is important later on. And again, you shouldn't think of it as like a thing to memorize, but just something to understand logically, that these variables will add to the national savings of a country. And the actual last thing we're going to talk about are the 3 uses of savings. So the first one is investment. And households save most of their money in banks, and banks actually lend that money out to businesses. And so those businesses then use that money to invest in new goods like factories, equipment, software, or constructing a new office. And so that gives us the idea that savings is equal to investment, that the amount of money that somebody's saving can then just be taken out and used to invest in something else. So the second thing is the budget deficit. We talked about this a little bit earlier when we talked about bonds. If the government spends more than it collects in taxes, it has a deficit, and to cover this, it issues bonds, and then people like you and me, and then also banks, buy these bonds with their savings. So savings can be used to cover the budget deficit. And then the last thing is the current account. So the current account you can kind of just think of as like exports and imports, like how many goods are going out of the economy and how many goods are going into the economy, as well as how much money is going out and how much money is going in. So savings by people in America can be lent abroad, and we can also borrow money from other countries. And so if we're lending money abroad, that's positive for the current account because we're going to make money off of it, while money borrowed is negative because we're going to lose money off of it. And then overall, the things you should really remember, you can kind of think of the savings in an economy as a pile of money. So businesses want to borrow from the pile to expand, invest in new projects, and make new products. And the government can also borrow from that pile when it runs a deficit. It can cover up the deficit by borrowing money. And this is why higher savings equals higher investment. The more money that is in banks and people have to save is the more money that businesses can borrow. And this is also why budget deficit decreases savings. And so just to wrap this chapter up, we can go back to the main points that you should memorize. The first being that national savings is equal to private savings plus the government savings, and then that the difference between savings and wealth, which is that savings is income not spent, and then wealth is the total value of all your savings. And then finally, the 3 uses of savings, which are investment, budget deficit, and then the current account. And that's going to be all for this first video. I'm going to make another video pretty soon that, like I said, will be less in depth about the topics, but I'll go over the most confusing aspects of macroeconomics. So thank you for watching this video, and I'll see you then.